The man leading the UK's Brexit negotiation has quit. UK Brexit Secretary David Davis resigning in protest over Prime Minister Theresa May's new plan for a soft exit from the European Union. He does not say that he believes, he says he does not believe in it. May already named his replacement, meanwhile, Dominic Raab, who was also a supporter of a clean break. Investors taking the news in stride as a wave of optimism about the resilience of the global economy is spreading across markets. Despite the escalation of the U.S. trade dispute with China, futures are this morning up 111 points on the Dow, up almost 30 points on the NASDAQ. Joining us right now is Art Hogan, Chief Market Strategist at B. Riley FBR. Art, it's good to see you this morning. Thanks so much for joining us.
Thanks so much for having me.
So I guess let's first talk about the resignation side. It's looking like one of the softest possible versions of Brexit. It appears to be cautiously welcomed by the markets. Your take on where London and the UK stand now in terms of that Brexit, and is a soft way out the way to go?
You know, it's interesting. Theresa May, has been a proponent of this soft Brexit, if you will, and the only hardliner in her cabinet that's decided to resign probably is the only egg that they need to break to make this omelet. I think they can press forward and probably the least amount of damage being done on the Brexit, and that's probably something the market's going to celebrate here. We certainly see a celebration going on in the British pound, and I think that's a good thing. So, as we look at what might be a Eurozone issue with the Brexit, I think that's one thing we can probably put in the rearview mirror, probably focus a little bit more on what Italy looks like after their election, and look at Brexit as probably not the worst case scenario coming to fruition.
So, Art, knowing what we do about where we are in earnings season, kicking off on Friday, you've got the Fed, of course, saying that they want to raise rates possibly 4 times. And as you just referred to, what's going on in terms of policy, potential trade dispute all around the world. What do you do with your money right now? How are you invested?
It's interesting. This market's really in a tug of war right now when we think about the 3 major concerns we have. Does the Eurozone collapse after the Italian election? And that probably takes much longer than, this year. So that's probably not this year's business. But there's some concern there. The yield curve is certainly not as steep as we'd like to see it, getting flatter on a weekly basis. And obviously trade being the biggest concern in the market as a headwind. And that's juxtaposed against what is going to be very good second quarter earnings for the S&P 500, again, in the 20% earnings growth on probably 10% revenue growth. That's hard to say that that's priced into this market right now. The S&P really hasn't reflected much of that. Valuations look very good. But I will tell you that if you're looking to invest your money, I still think the Russell 2000, small and mid, domestically focused, are going to be more resilient this year as trade policy continues to be a headwind and will be for a period of time, at least, up and until the November election cycle. So I would say that if you're looking to put new money to work, I'd rather see it in the Russell 2000 than the S&P 500 right now, although earnings are going to be very good.
All right, this is Christina Partsinevelos. You listed a few concerns, but you didn't actually list business investment. Are you concerned at all, given the peak in M&A activity? You're seeing wage growth not where it should be. Are you worried that businesses aren't investing back in the American economy right now, aside from trade? Well, that's just in general.
Yeah, that's right. I think that's one thing you're going to hear about, right? So there's a lot of cash in the balance sheets in corporate America. Right now, we've seen M&A activity actually, at a record pace in the second quarter on a year-over-year basis, much higher than it was last year. And you're seeing buybacks and dividends being out. So, to the extent that that cash is being put to use, the problem with that is as trade becomes a concern, and we'll hear about that in conference calls during earnings reporting season, what is it that corporations do? And do they stop plans or at least halt plans for CapEx and putting money back into work in the U.S. economy, as you bring up? I think we're going to hear a lot about that, very much in contrast to what we heard in the first quarter. The first quarter was all about, hey, we've got a lower effective tax rate. That's great. Here are our estimates for the balance of this year. In the second quarter, I think it's going to be that concern that, hey, we're not sure what our supply chain is going to look like. We're not sure if we want to invest back into our business. And I think that, will come out during the earnings over the next couple of weeks. We'll hear that in conference calls.
Art, this is Lee Carter. I'm always interested to see how the markets go versus how public opinion goes. And you see right now about 2/3 of Americans still believe that this trade war isn't going to turn into a trade war, and the president ultimately is going to win out on these negotiations and fulfill his promise of America first. Now, a lot of people do believe that's going to happen. At the same time, there's a very, very vocal minority who are very concerned, who think that this is going to turn into a disaster and that the American people have yet to even feel the impact of what just happened on July 6th, and then it's going to be a slippery slope going forward. How do you see it?
Well, that's interesting. So this has been one of those conundrums that we face, right? It's like, hey, we have to get used to this style. It's the art of the deal. We have to get used to this style of negotiations. And it's very difficult to watch, right? Unless and until it becomes economic, corporate America will continue to grow earnings and will continue to have a strong economy. The second quarter is probably going to have a 4% GDP growth rate. Earnings for the second quarter are going to be in the 20% range. The problem is, do I, as a business, regardless of how things are going, make a decision to either shift production someplace else other than the United States because of what's happening to my supply chain or to my raw material costs? Or do I say, you know what, this is going to work out in the end? All of that speaks to a delay in spending by corporate America. I think that's where it becomes a concern. So in the third and fourth quarter, we may see less economic activity as decisions are delayed until we find out what the end game is on trade. So I'm not saying it's going to be a disaster. I'm certainly telling you that it can affect business decisions, and that's when trade policy turns economic and can be a deterrent to economic growth.
Mitch.
Art, one of the things so you mentioned M&A. The other thing we're also seeing is share buybacks. And to Christina's point, we're really not seeing that spending on capital expenditures and reinvesting in the business. When you have such strong earnings growth, wouldn't you think companies would want to take some of the benefit of tax reform and plow it back into the business to fuel future years' worth of earnings growth?
No, absolutely. And that's, ideally, that's what you'd like to see, right? You've got a lower corporate tax rate. You've got more cash in your balance sheet. The ideal situation would be to invest in your own business. Now, at what cost and where do you do that, right? So, to the extent that you think about who is growing and who has the ability to do that, and we're certainly seeing that in some of the, technology companies.
Yeah.
But, if you're in manufacturing right now, that may not be the case. Or if you're, in the auto industry right now with a very complex supply chain and supply chain management.
But Art,
it's very difficult to say. Yeah.
The top story in the Journal this morning is that U.S. companies are buying back record amounts of stock. That their shares are not actually getting the boost that they bargained for. Why is it that, the number is huge. S&P 500 companies on track to buy back a record $800 billion in stock this year, but the issuers are not getting the share price boost the move usually brings with it. Top story in the Journal this morning.
Right, and I tell you, Maria, the reason that's probably not moving the S&P 500 as much is, as a headwind, trade continues to be out there, right? So unless and until we have some resolution, unless and until we see the positive benefits of what trade policy is going to be, the S&P 500 is going to have a problem, right? So, that is why you're seeing a massive outperformance in the Russell 2000. It's less affected by these things like the strong dollar and trade and tariff, et cetera.
So going into the second quarter earnings season, we got the banks coming out on Friday. Would you buy the Russell 2000 index, or do you want to avoid the banks going into the earnings?
Well, the banks are going to have their own individual problems, and I think that has a lot to do with the shape of the yield curve, right? So the 2-10 spread hasn't been any tighter than this, for a dozen or so years, and that is problematic for banks, right? They don't have that net interest margin. They can't, they can't borrow short and lend long because there's no margin there necessarily. And if there's going to be a slowdown in global economic activity because of trade, the banks are probably not the place you'd want to go. I will tell you this: if you're looking at that second quarter earnings reporting season in general, it's going to be very good for the S&P 500. But I think your better investment option is to look small and mid-cap and domestically focused like the Russell 2000.
All right, we will leave it there. Art, always a pleasure to see you. Thanks so much.
Thank you.
Art Hogan joining us this morning.